So here is group 5. We are presenting on financial ratio and financial analysis of Parkson Holding Berhad. And I introduce myself. I'm Caroline Ananandi, and my other 5 members, Leno Linem, Nur Khalida, Nur Eza Fazlina, Mohammed Jamil, and Farah Nabila. Here a little background of Parkson Holding Berhad. In 1987 at Sungai Wang Plaza, Parkson opened its first store. Since then, over the past 27 years, the new store have been rolling out around the country at about 2 stores per year. Parkson Pavilion, the flagship store, was opened in 2007, and Parkson has 42 stores in Malaysia as of January 3rd, 2021. Parkson is on journey of restarting and recently closing its Kuala Lumpur store at Maju Junction. Founder of Parkson was William Cheng, and the first headquarters was at Kuala Lumpur, Malaysia, with 131 department stores throughout Malaysia, Indonesia, Vietnam, and Myanmar, but not to forget China also. The total revenue per year was 3554 million based on financial year 2014, and with net income of 240 million yearly. Parkson Holding Berhad parent company was Lion Group and has 6 other subsidiaries company in Asia. On 26 August 1892, under the Company Act 2016, Parkson Holding Berhad was incorporated in Malaysia as a private limited liability company under the name of Amalgamated Cement Mills Sdn Berhad. It was subsequently renamed Amalgamated Containers Sdn Berhad on 27 August 1988 and transformed on 17 August 1992 into a public limited liability company under the name Amalgamated Containers Berhad. PHB is an investment holding company listed on the Singapore Exchange Securities Trading Limited and the Stock Exchange of Hong Kong Limited, with shares in Parkson Retail Asia Limited (PRA) and Parkson Retail Group Limited (PGRL) respectively. Its subsidiaries are engaged in retail business, the operation of department store and food beverages firm, investment interests, land management, property creation and project management, advisory or management service, cosmetic and related product wholesale and retail, trendy goods distribution and retailing, money lending and credit service provision.
Liquidity ratios are an important classes of financial metrics which determines the debtor's ability to pay off its current debt obligations without raising any external capital. There are 3 ratios need to be calculated under liquidity ratio. The first one is quick ratio. To calculate QR, the total of current asset and inventory will be divided by current liability. In Parkson financial statement for the year 2020, its current asset is 2296795, while the inventory is 360533. Total of those two is 2657328, which will then be divided by the current liability amount to 2670140. The quick ratio for the 2020 is 0.72 times. In Parkson financial statement for the year 2019, the current asset is 2904591, while the inventory is 366589. So total of those two is 32811180, which will then be divided by current liability of 22036681. The quick ratio for 2019 is 1.15 times. A result of 1 indicates a normal quick ratio. It shows that a company has enough asset to liquidate to pay off its current liability. If a company quick ratio is less than 1, they might not be able to pay the current liability in the short term. From here we can see Parkson has higher quick ratio in 2019 compared to 2020, which indicates they have more asset in 2019 compared to 2020 to pay off its debt. Second ratio is current ratio. Current ratio is calculated by having total current asset divided by total current liability. For the year 2019, the current asset is 2904591, which will be divided by current liability amount to 22036681. For 2019, Parkson's current ratio is 1.32 times. For the year 2020, the current asset is 2296715, while the total current liability is 2670140. For the year 2020, Parkson's current ratio is 0.86 times. A ratio under 1 indicates the company's debt due in a year or less are greater than its assets. If a company current ratio is higher than 1, they might show that they are able to pay their debt in the short term, but it also indicates that they are not using their current asset efficiently. From here, we can see Parkson has higher current ratio in 2019 compared to 2020, which indicates they are able to settle more debt in 2019 in short term compared to 2020, but they might also not be using their current asset efficiently in 2019. Last ratio need to be calculated is cash ratio. Cash ratio is calculated by total of company's cash divided by total current liability. In Parkson's financial statement for the year 2020, their total cash is 1376751 and will be divided by their current liability, which is 2670140, and their total cash ratio is 0.51 times. In Parkson financial statement for the year 2019, their current asset is 1637779 and will be divided by their current liability, which is 2203681, and their cash ratio is 0.74 times. If a company's cash ratio is less than 1, this shows there are more current liabilities than cash and cash equivalent. It means insufficient cash on hand exists to pay off short-term debt. However, if a company's cash ratio is higher than 1, the company has more cash and cash equivalent than current liability, which indicates they are able to pay off short-term debt. Sometimes low cash ratio indicates maintaining low cash reserves or the money is being kept for expansion. Higher cash ratio means the company is leaving their money stagnant. It might also indicate inefficient in the utilization of cash. If we look at Parkson's and Berhad, both years shows cash ratio less than 1, which might indicate Parkson is not able to pay off its debt both on these years, or might use the fund for expansion.
Let us continue with the leverage ratio. So for the first formula is debt ratio. In 2019, 61% of company total asset is represented by total debt. Meanwhile, in 2020, the total debt represented in total asset is increased to 75%. This means the company experienced higher risk in 2020 than 2019. It is because the company increased the use of debt to finance their total assets. Next, debt to equity ratio. For year 2019, the company total asset that is financed by debt is higher against equity, which is at 1.5 times. Meanwhile, for year 2020, the debt used to finance total asset are once again higher than equity, which is at 2.98 times. This interpretations as the company in 2020 is highly leveraged and risky compared to 2019. For the last one is time interest earn ratio. The capacity of the company to serve an additional loan in 2019 is at 0.59 times. Meanwhile, in 2020, the capacity of the company is dropping at 0.19 times. This means the capacity to serve an additional loan in 2020 is lower than 2019 due to the debt used in 2020 is higher than 2019.
Next is activity, or we call it as efficiency ratio. To calculate inventory turnover, the calculation need cost of sales and also inventory. The cost of sales figure was taken from Parkson Holding Berhad statement of profit or loss, and for the inventory is stated under current asset from consolidate statement of financial loss. In the diagram, you can see Parkson Holding Berhad inventory turnover ratios are 4.49 times for 2020, while for 2019 is 5.03. This shows that Parkson Holding Berhad have an efficient inventory turnover on 2020 rather than 2019. Since the lower the bigger is the better. The greater the number of stock itself could means that the more sale must be taking place for by the company. For the account receivable period, it shows that Parkson Holding Berhad's account receivable period are 17 days for 2020 and 14 days in 2019. This ratio shows that how long on average people who in the company itself has given credit to or debtor are taking to pay. So in the diagram, 2019 is better ratio since they have a shorter figure, that is 14 days, that typically give a better result for Parkson Holding Berhad itself, as it is collecting their debt quicker than 2020, which is 17 days. Next, for the total asset turnover, both sales and total asset was taken from the consolidated statement of financial position of Parkson Holding Berhad. And the company scored 0.31 times for 2020, while for 2019 they score 0.47.
So now let's move to the profitability ratio. So in profitability ratio, we have 5 steps, which is the first, we need to find out the GPM, which is gross profit margin. Second is the operating profit margin, which is OPM. Third is the NPM, which is net profit margin. The fourth one is return on asset, and the fifth one is returns on equity. So the first step is the finding of the GPM. This can be found at gross profit times divided by sales and times 100%. So in the years of 2020, we can get is 1633520 divided by 3211152 times by 100, so we get 50.24%. So in 2019, we got 2188277 divided by 2032655, then we times by 100, so we got 54.26%. So in operating profit margin, which is the way we got it from the operating sales divided operating profit divided by sales, then we times by 100. So in the years of 2020, we get 747261 divided by 321152, and then we times by 100, so we got 22.98%. In the year 2019, we got 349945 divided by 4032665, then we times by 100 again, and we got 8.678%. So in the net profit margin, we got it from the net sales and divided by sales, net income divided by sales, and we times by 100. So in the year 2020, the net income is 627,248 divided by the sales is 3251152, and then we times by 100, which is then we got 19.29%. So in the previous year, which is 2019, the net income is 152,268 divided by the sales of that year, which is 4032665, and then we times by 100, so we got 3.78%. In ROA, the ROA is we get from net income divided by the total asset, and we times by 100. So in the years 2020, we get the total income, which is 627,248, and then we divided by the total asset, which is 10,455,546 times by 100, so we get 96%. So in 2019, the net income of that year is 152,268, and then we divide by 8,535,916, and then we times by 100, so we get that ROA in 2019, which is 1.78%. So in return on equity, which is ROE, the formula that we can get is net income divided by the shareholder equity times by 100.
So in the year 2020, the net income is still the same, 6 for that year, which is 627,248, and then we divide by the shareholders of equity on that year, which is 2020, is 2623 at 6, and then we divide, and then we times by 100, which is that's equal to 23.9%. So last but not least, for that 2019 years, which is the income tax, the net income of that years is 152,268, then divide by that shareholders equity on that year, which is 3,311,248, and then we times by 100, then we get 4.56% in that year. So that's all for the profitability.
Assalamualaikum. My name is Nur Eza Fazlina binti Abdul Basit, and I will proceed with the next slide, which is financial analysis for liquidity ratio and leverage ratio. So under liquidity ratio, current ratio measure whether the company has sufficient resources to pay its debt over the next business cycle by comparing the current assets of the company with its current liabilities. So the result indicate that for every 1 ringgit of current liabilities that relating to group in 2020, it has 86 cents worth of current asset compared to the year 2019, which was decreased sharply by 0.46. In 2019, it has 1 ringgit 32 cents. So this means that the business tends to have insufficient liquid assets and will have difficulty repaying its liabilities on time. However, in 2020 rather than 2019, it may not survive. Quick ratio exceeding 1 means the company has sufficient quick assets to pay for its current liabilities. Quick assets are current assets that can be converted easily into cash. The quick ratio in 2020 is 0.72 times, while in 2019 is 1.1 times. For every 1 ringgit of current liability, the company has 0.43 cents less of quick assets to pay compared to 2019. So this means that when the ratio is below 1 to 1 in 2020, the company will rely too much on inventories or other assets to pay for its short-term skills. Cash ratio evaluates the capacity of a company to pay off its current liabilities with cash and cash equivalents only. The ratio is much more conservative because no other capital assets other than cash can be used to finance current debt. So in year end 2020 of relating group, it shows that the cash ratio is 0.51 times, while in year end 2019 is 0.74 times. So this means that when the ratio is below 1, the company needs more than just its cash reserve to pay off its existing debt. So the company concerned does not have sufficient cash to pay off its existing debt. So this means that when the ratio is below 1, the company needs more than just its cash reserve to pay off its existing debt. The company concerned does not have sufficient cash to pay off its existing debt. So next is leverage ratio. Leverage is a ratio of a company's debt and equity. The debt ratio shows how well a company can pay their liabilities with their assets. So the results of debt ratio that the relating group has in 2020, it has 75%, which 14% higher than 2019 that has 61%. A lower value of the ratio is better than a higher number. This is because a lower ratio signals a stable business with a lower proportion of debt, while a higher ratio means that the creditors of the company will demand a higher percentage of the assets. So the relating group should therefore always strive to keep the ratio within a reasonable range. For debt to equity ratio, it is a long-term solvency ratio that indicates the soundness of a long-term financial policies of a company. The relating group in 2019 shows that better than 2020. The result of 2019 is 1.58 times compared to 2020, which has 2.98 times. So the lower is better because it represents the willingness of shareholder equity in the event of a business downturn to pay all unpaid debts. So next is times interest earned. Times interest earned ratio is a measure of a company's ability to meet its debt obligation based on its current income. The result shows that in 2019 is better than 2020. In 2019, it shows that 0.59 times compared to 2020, only 0.19 times. So 4 times interest earned, the higher is the better, because a higher rate of interest earned is advantageous, because it suggests that in terms of solvency, the company provides less risk to investor and creditors. It indicates that the relating group is stronger in 2019 compared to 2020.
Inventory turnover is to measure the efficiency of company with respect to managing its inventory stock to generate sale. The result of inventory turnover for Parkson Holding Berhad in 2020, 4.49 times lower than 2019, 5.03 times. A lower inventory turnover in 2020 indicates that Parkson Holding Berhad is not managing its inventory well. It may be overstocking, or it may be have an issue with the sale. Average receivable period is measuring the number of days between the date credit sales has been made and the day when the money received from the buyer. Parkson Holding Berhad shows that 2019 was better than 2020, because in 2019 the result of the ratio was 14 days lower than 2020, 17 days. The lower is better because the result will indicate on the average of how many days the company inventory is held until it is to be sold. For total asset turnover, the result was in 2020 0.31 times lower than 2019, which is 0.47, which mean that's not good for Parkson Holding Berhad, because the company need generate more sales with some certain level of asset. So overall, this can be concluded that Parkson Holding Berhad company in term of activity or efficiency ratio not perform better, and it shows that the company is not able to manage their asset effectively to generate sale. On profitability ratio analysis, the gross profit margin determines how much the company makes from its sales by deducting the cost of goods sold. So for 2020, the Parkson Holding Berhad showed that the GPM is 50.24, and 2019 54.26%. 2020 slightly lower than 2019, which it looks that the company not doing well to control its abilities to pass on the cost to its customer. The Parkson Holding Berhad operating profit margin shows that 2020 is 22.98%, which is higher than 2019, 8.678%. This implies that for every 1 ringgit of revenue earned by the company, The revenue is enough to cover the firm's total operating expenses. This means that in 2020, the company does cover more on operating expenses compared to 2019. For net profit margin is to measure how much the company revenue remain after deducting all operating expenses and interest on borrowing from the company. Paksan Holding Berhad net profit margin for the year 2020 shows that 29% higher than 2019, which is 3.78%. It indicates that this 2020 year's profitability may be secure. Next, return on asset provide the information regarding the efficiency of the company's management in using their fund. In 2019, the Paksan Holding Berhad show return on asset of 1.78%, lower than 2020, which is 6%. The investor can conclude that for every 1 ringgit of funding provided to the management of Paksan Holding Berhad, the firm is able to earn a return. It can be seen that the return in 2020 is better than 2019. For return on equity, it is to provide investors with the ability to determine the amount of return they obtain for each 1 ringgit of the fund invested in the company. In the year 2019, the Paksan Holding Berhad shows return of equity of 4.56, lower than in year 2020, which is 23.90%. This shows that the level of return that shareholders are getting is higher than 2020. To conclude, the Paksan Holding Berhad is a well-known company that is really difficult to have scandal or governance issue because we can see from the financial statement, the company has doing well in liquidity, leverage, activity, and profitability ratio. Paksan Holding Berhad knows well to manage their asset and debt, even though there might be a minor flaws in their financial analysis. It shows that company can identify the way to improve their performance for the better future and success well-known company.